Welcome, and thank you for joining today's Market Surveillance Committee meeting. Before we begin, please ensure you have opened the WebEx participant and chat panels by using the associated icons located at the bottom of your screen. Please note that all audio connections are muted at this time. If you require technical assistance, please send a chat message to the event producer. Questions will only be taken over the phone for today's meeting. To ask a question, please press #2 on your telephone keypad to enter the question queue. If you press #2 again, you will step out of line virtually. So please don't press it again unless your question has been answered. If you do, you will be out of place in the line. And with that, I will turn the call over to Dr. Benjamin Hobbs, Chair of the Market Surveillance Committee.
Thank you very much, and good morning, everybody, or good afternoon here on the East Coast. I'm glad to see you all back after a week. We're refreshed and ready for some additional agenda items. Today we have two very important items, one on congestion revenue rights and the performance of the auction system. And then this afternoon, we'll be talking about system market power mitigation. First, let me introduce who else is around the virtual table here. So besides myself and the other two members of the MSC, Scott Harvey and Jim Bushnell, I'd also like to welcome staff from the ISO, which include, if I understand, Shami Davis, Greg Cook, Guillermo Batista, Anna McKenna, Brad Cooper, and is there anybody else from the ISO here?
Abhishek. This is Abhishek.
Oh, hi, Abhishek. Thank you very much for joining us. So before we launch into the CRR discussion, as is usual, I would like to welcome public comment on issues, preferably ones other than those that we'll be covering during the meeting today. So at this point, I would, operator, I'd like to open up the phone lines, see if anybody has a public comment or question.
Once again, pressing #2 on your phone will indicate that you wish to make a comment or to ask a question. At this time, no one has raised their hand.
Okay, thank you. Okay, so now we'll go to the congestion revenue rights discussion, and we will begin with a presentation by Dr. Guillermo Batista, who's the Director of Market Analysis and Forecasting at the ISO. And Guillermo, it is all yours.
Thank you, Ben. Thank you for the introduction. Good morning, everybody. Thank you for having the time for going through this topic. And back in March, we provided an update about the CRR performance. This was in the last MSC forum. I covered generally the different areas impacted by the policy changes. We posted early this week a report with the performance analysis of the CRR market for the first 15 months of production after we have implemented the 3 main policy changes. This morning, I'm coming back to further discuss the CRR performance, specifically in 2 main areas. The first part is the continuation of the discussion about the auction efficiency metric, and the second part will be focused more on the significant CRR deficit that we observed in the last quarter of 2019, and what the drivers for that deficiency were. I don't expect to go over all the topics that we already discussed in March or that are listed in the report, but if you have any specific questions, I will be happy to address those in this call. To put us in context, what we are assessing here, let me go back to what we did prior to the current production paradigm that we have. We initiated an analysis, what we call the phase 0, that was related to tuning up and improving our internal processes. Then we moved into the policy discussion that was comprised of 2 parts. In the first phase, we implemented basically what we call the elimination of the non-delivery paths. And in the second phase, we targeted the revenue adequacy issue by implementing a pro rata funding. Together with that, we implemented the reduction of the capacity release in the annual process to move from 75% to 65%. And effectively, all these changes, even though they may have implemented at different points of time, they are adopted effective in January 1st, 2019. So all of them came concurrently into the settlements of the system. Next slide, please. Okay, when we analyzed the CRR performance as part of the policy initiative back in 2017 or so, we focused on two main areas. One was the auction efficiency, and the second was the revenue adequacy. For the auction efficiency, we developed a metric that we call CRR auction revenue shortfall, which can be expressed in a dollar or as a percentage. This metric is a very straight calculation and compares the auction revenues to the CRR payments only for CRRs that were released in the auctions. This is what we call auction CRRs. When you think about these two components, it's quite easy to understand the concept. Basically, how much a participant has to pay to get a CRR versus how much that same participant for that same CRR is actually paid when settled in the day-ahead market. If, for instance, the auction revenue was 80 cents, it means the participant paid 80 cents to buy the CRR. And then the CRR payment in the day-ahead market was, let's say, $1. The metric is either 20 cents or 80%. The 80% indicates that a participant is getting $1 on 80 cents. When we implemented the policy changes, there are now some nuances that became evident and for which we have to account for. I will explain this in the next slide. But in a nutshell, we take two items in the net auction revenues and the CRR payments. We were taking all the CRRs that were traded in the auction, regardless who traded, what the origin of the CRR was, or whether it was of prevailing or counterflow directions. We didn't distinguish. We just considered as long as it was traded in the auction, it was a CRR to consider. It didn't matter if that was an implicit sell of a CRR or a buy a counterflow position. So this metric effectively included three different dynamics, which are, one, the auction efficiency related to buying CRRs, as the example I just indicated. But quite deep in the calculation, implicitly, we are also measuring, to some extent, the arbitrage opportunities between auctions, going from the annual into the monthly, and also the undervaluation of selling allocated CRRs. That metric prior to 2019 was good, was accurate on its own terms, and it captured all these three components. The challenge after the policy changes implemented in 2019 is that we no longer have the visibility on all these components. This, therefore, has required to go back to pre-2019 metrics and make the corresponding adjustments to basically have a consistent comparison before and after the policy changes. And let me explain more the details of this. Can we please move to the next slide? Okay, let me be crystal clear on what we are doing. We continue to assess the auction efficiency. That is the metric we had before 2018. That is the metric that we continue to have after the implementation of the policy changes. The difference is that we are doing a calculation of the auction efficiency to account for the new nuances of the data that is available to measure that metric. Once we do that, then we used to use the same basis of what we do in 2019 for pre-2019. So we need to remain consistent before and after. In the report that we posted, we are being totally transparent on the calculations and the implications of this revision of the metric. I understand this may be overwhelming for some people. In the report, I provide 4 types of channels to provide the changes. I provide illustrations, a numerical example, a detailed explanation step by step of all the settlements implications, and then a set of formulas that summarizes effectively what the calculation is. I'm providing 4 different ways to explain what we are doing and why we are doing it. And I understand this may be overwhelming for some people, but as long as you can read it through the detail, I think it should be transparent on what we are doing. Now, the complication, as I said, arises once we implemented the policy changes. It is here where the details really matter. And for that, let me use 2 illustrations. The upper part is an illustration of the before and after. The first 4 groups on the left, numerated accordingly, reflect the logic of the pre-2019 CRRs that participated or were traded in the auction. The far right, the number 5, is the current construct that we have after the policy changes. When we go after the auction efficiency metric, we just said, okay, give me all the CRRs from the auction, no matter what the reason, the motivation is. As long as it's a CRR traded in the auction, we accounted for in the auction efficiency metric. If we start going now into the details, we actually can break this group 1 into the group 2. And you are going to find 2 types of CRRs. All of them are buy CRRs. All of them were bought in the auction. But the driver behind is different. You can have one component that is what we call the buy prevailing CRRs. It's the typical CRR in the prevailing direction to get a hedge. The other component is really what we can call the buy counterflow CRRs. Those buy counterflow CRRs typically are going to be related to negative prices and may indicate that they are going in the counterflow direction. One step further, if we go now into the group number 3, you can break down the buy counterflow in 2 subgroups. One is what I call the implicit sell CRR. And I call it implicit because prior to 2019, there was no explicit feature for participants to be able to sell an existing CRR. The only way a participant with an existing CRR willing to get rid of that CRR, to sell that CRR, was to buy a counterflow CRR. Basically, you just buy a CRR that is in the opposite direction. And then you have the other group, still in green, the 2.2, that is effectively to buy a counterflow position. This is not to sell or to get rid of an existing position. It's just to bid against the market having a counterflow position. One step further, we can go into the group number 4, and you can break further the section in red in 2 groups. One is what we call the implicit sale of allocation CRRs, and the other group is the implicit sale of option CRRs. These are sales of CRRs that are already in the CRR portfolio of a participant. The origin of that CRR is different. One was directly allocated from the allocation process. The participant nominated that CRR and got that allocated. The other one was actually bought actively in the auction, and then now they want to sell that CRR. Again, because there was no explicit feature for selling CRRs, the only way was to do by buying a counterflow. That doesn't negate what the driver behind was. When we discuss the initiative in the stakeholder space of the policy, we targeted basically the component in group 4 in green. We wanted to eliminate the non-delivery paths that are basically going from generation to demand locations. From demand to generation locations. That is the piece that if you go now into the group number 5, you are going to see it's no longer available. There may be some CRRs that are still buy CRRs with negative prices. It could happen. But if you compare now group number 4 versus group number 5, you can see that there is a small variation here. And let me try to elaborate on that. Not to get you bored with the details of how this is implemented, but when we were doing the auction efficiency metric prior to 2019, the fact that there was a record of an allocation CRR and there was a record for a counterflow CRR, a buy CRR, it implied that in our system we track explicitly 2 records, one allocation and one auction. Effectively, if it was a CRR to be sold in the auction, these two records net each other to zero effectively. And the effect at the end in the settlement is zero. You buy 100 and you are selling 100, and the price cancel each other, and you get effectively zero settlement for that pair of allocation and buy counterflow. Because of that, we were able to keep track explicitly of what the value of the sold CRR was. That is the complication. Once we go into the 2019, that visibility no longer exists. In 2019, given the fact that we have an explicit sell feature, if a load-serving entity has an allocated CRR for 100 megawatts and now wants to sell it, it puts explicitly a sell bid for 100. It was awarded with this clear. Basically, that CRR is liquidated up front. You have an allocated CRR for 100. You buy now a sell CRR for 100. Well, you sell a CRR for 100. Your net position is zero. When we go into the settlement of that portfolio, we don't track and we don't settle allocation 100 and auction minus 100. We settle at zero CRR. Basically, nothing is settled because it's effectively liquidated. Therefore, we cannot know explicitly what is the implied CRR payment for the CRR that was sold. Because again, the settlement is for the net, for the zero. With that complication, we can come into the assumptions of how can we potentially estimate what the implied value of the CRR payment would have been. That is something we are not going to explore just because of the many assumptions we have to take. But that puts us in the position that now we don't have that extra piece of information on what is the implied value for the CRR payment for the CRR that was sold. We did have that prior to 2019. If we really want to make an assessment how the policy changes have played out before and after the implementation, we need to have a consistent basis before and after under the same construct. Therefore, if we don't have that component of the explicit value of the CRR payments for the sale of the allocated CRRs, what we can do is to not account for the corresponding auction revenues in the auction revenues. Effectively, we are basically not accounting anymore for the portion in gray in this illustration, simply because the CRR payment for the gray portion is not known. We don't know it. In order to remain consistent, we don't have to account for that either in the auction revenues. What you have here in the formulas, there are two variations. One is the 2019 and one is the pre-2019. And you can see the auction efficiency ratio in this case is the auction revenues divided by the CRR payments. It has two components. The component in one, that is the typical buy CRR, and the component 2.1.2, that is the explicit sell for auction CRRs. We do track the auction CRRs because they are of the same nature, and even though they net, we know exactly how they were netted. It's not the case for the self-allocated CRRs. So now we have to go back and do the same alignment that we have for the pre-2019. With the caveat that in 2019, in addition to these two components, we also have the component in green, because at that time we are still allowed to buy counterflow positions. That is the change we have to make to the metric, not because we don't believe the auction efficiency that we originally had was good or not good. It's because we need to remain consistent to be able to measure under the same basis before and after. I would like to pause to see if there is any clarifying questions to this point, because I think this is the key point to understand the metric. Can we see if we have any questions?
We have one person who's raised their hand. As a reminder, though, pressing #2 will indicate that you wish to ask a question. Please go ahead.
Hi, Guillermo. This is Seth with DC Energy. Thank you for putting this together. I think it's pretty informative to see things broken out. I was wondering also, did you have a chance to break out the counterflow portion of this notation system that you have here? And I think that could be important to also break out the counterflow. because there was more counterflow in the auctions pre-2019.
Yeah, so this was a challenge that I have because I think by the level of breakdown that I have put forward, it may be already overwhelming for some people. I think there are still many other ways you can slice and dice the pool of CRRs. I think there could be still some merit to that breakdown. At this point, I haven't done it. I think with the breakdown that I have so far, I have created enough confusion in the market.
Okay, right. Yeah,
Dan,
I understand.
Sorry. Oh, sorry. This is Jim. I just wanted to clarify. So when you say break out the counterflow, are we talking about in the pre-2019 period to basically sort of make this more directly comparable before and after? Is that what you're getting at?
Yeah, so that would be the 2.2 category. Right. So the idea is that prior to 2019, there was more counterflow. And that counterflow, essentially, it reduces the auction revenues that show up. So you can get a situation where the averages start to get skewed when you compare them between the years because you're comparing positive and negative numbers together. And I can show examples of why that doesn't always work and how the skewing happens. But I think it would be helpful to see counterflow separated out along with this metric as well. Yeah, and it should be easy.
I mean, the counterflow, go ahead. But Seth, the counterflow should be associated with payments in. So I think I can understand looking at it separately, but I don't see how it leads to an incorrect result the way the overall picture is going to be accurate, because as long as you include both the auction price and the auction payout, the data market payout.
Yeah, I mean, if the ratio of counterflow to prevailing was the same across the years, then that would be true. But what the counterflow ends up doing is it greatly reduces the apparent average clearing price per dollar of the congestion revenue. And that effect happens more pre-2019 than it does post-2019, and you can see some skewing in the numbers. It's difficult to explain that just orally over the phone, but I could provide examples of why that's the case.
Well, yeah, I agree. If we were calculating an average sale price where we added together the positives and negatives and divided by the total megawatts, I can see that would be affected by including both positives and negatives, but I don't recall that anybody's looking at that.
Okay. Maybe I'll follow up with you with some examples. It's pretty easy to digest examples. You could maybe see the point I'm raising.
Yeah, I kind of
that would be helpful.
And I understand you. Basically, what we are doing right now is taking all the buy CRRs, whether they are prevailing or counterflows, as one single pocket. Naturally, the positives are going to be offset with the negatives. What you're really asking is the breakdown of the buy CRRs into the two groups, the positives and the negatives. Effectively, the overall metric is not going to change, but I guess your point is that the relative contribution of each one is going to be different. Is that correct?
Yeah, I do. I think it's going to show more meaningful comparison across the years. Yes.
Okay, let me see what I can do. I don't know. Again, the overall value at the end is going to be the same because it's a matter of how you slice and dice that blue area.
Yeah, I also don't agree. I don't understand the relevance. So I think you ought to send us some examples on Guillermo and the MSC, and we can try to puzzle it out.
Okay, will do.
Okay, thank you, Seth. Candace, do we have any other questions?
Yes, we do. Please go ahead.
Hey, Guillermo and Scott, it's Everett Klein with That Being Way. One quick comment on Seth's. I think Seth's point is that a lot of the justification for eliminating the ability to do counterflow CRRs was based on metrics that if you unbundled the averages might have looked very different. So I think it'd be helpful for Seth to pull together an example there. Guillermo, I'm wondering if you could just walk through again the metrics, because there's a lot of both the pre and the post-2000 metric, because I'm just not understanding the formula, like what does RAF stand for, what does AR stand for, et cetera, et cetera. Yeah, just.
Sure. So this is the auction efficiency metric that we have. That is the ratio of the auction efficiency, it's the percentage that I was referring to. Let me start with the 2019 metric. This is no more than the ratio of the auction revenues in the upper part divided by the CRR payments in the lower part. So if, the example that I indicated earlier, you have bought a CRR for 80 cents, and now the CRR payment is $1, effectively this is going to be 80 cents divided by $1, that means 80%. That is the original auction metric that we used to have, altogether, regardless of the nature of the CRR. For the 2019 metric, after we have lost the visibility of what the implied value of the CRR payment is for selling allocated CRRs, this metric remains the same, but only for a subset of the CRRs, basically for all the CRRs that are purchased in the auction. It doesn't include the sale of allocated CRRs. That's the only variation. We are dropping one component associated with the explicit sale of allocated CRRs. Now, because we have that component no longer tracked in this metric 2019, we have to go back to the pre-2019 and make it consistent, effectively dropping the portion in gray in the same way. You can see that the pre-2019 has an extra component because at that time we still have the non-delivery points, that is the component 2.2, but still it's a buy CRR. Effectively is the metric still based on buying CRRs or trading CRRs in the auction without the consideration of the CRRs that are being sold from allocated CRRs.
Okay, thank you.
At this time, there are no further questions.
Okay, thank you, Candace. Guillermo, please proceed.
Okay, next slide, please. Okay, so what I'm going to start showing here now is different metrics. One of the features that, or capabilities that we gain by breaking down the CRRs by these different types is that it allows us to actually measure, to some extent, the different components. And before it was just one single metric, 80%, we didn't know the different components. Having this slicing and dicing of the different CRR types allows to actually assess the efficiency of each of these components. The first part that you have here is the auction revenues broke down effectively by the same groups that I described in the previous slide. The color code is kind of the same, so you can easily track those. And the markers with the dotted line in purple stands for the net auction revenues, offsetting the negatives with the positives. And this just tells you what is the trend over time after and before the changes that we implemented in 2019. Obviously, the auction revenues as a net have reduced to some level, and we have discussed that extensively in the past. The interesting part is that you can see that all the other components remain in place, and some of them are actually increasing, like the volume of the negative auction revenues have actually increased. And that is in part due to the next topic I'm going to cover, that is the sales of allocated CRRs. So when you compare on an annual basis in the upper right the volumes of auction revenues before and after, you can see that yes, they have dropped, the proportions remain in place, the negatives have increased, and that is somehow expected. We eliminated a whole portion of the bits that we allowed before. Naturally, you could see that that capacity is going to be less, and therefore less transactions may imply less auction revenues. not to the extent that you could expect based on the proportion of the reduction that we have seen for the volume of transactions eliminated. Next slide, please. Okay, one of the components that now we have explicitly assessed is the sales of allocated CRRs. Before, as I indicated, they were classified as buy counter flows, and unless you go and track exactly if that buy counter flow belongs to an allocated CRR, everything was treated the same way. Now we are able to go back and track explicitly what they were being sold as implicit by CRRs, and compare that in the same basis for after the 2019 changes for the explicit sale CRR that we have. And you can see there is a trend here. It's an increasing trend. It is as low as, I would say, 1,000 megawatts in early 2017, and that has increased up to about 3,500 megawatts in the end of 2020. So the trend is increasing. More allocated CRRs are being sold in the auctions, and the dotted marks in red reflect the clearing ratio. The light blue portion on the top reflects the amount that is not clear. So effectively, the high of the whole bar stands for all the capacity that was offered for sale. The darker is only the portion that actually cleared. And you can see the clearing is quite high. For sale CRR, we are talking about, on average, clearing ratios of about 80%. So 80% of all the CRRs that were put for sale were successfully cleared in the auctions. And that may give some signal of how pricey, how much they are being sold at discount or not. Do I hear a question there?
Yeah, Guillermo, this is Jim. I just had a quick question about the volume of allocated CRRs generically. Was there any kind of notable shift in the megawatts of CRRs going through the allocation process? Because as I understand this graph, this is the total quantity being sold in the auction. As a fraction being allocated, is that even higher or lower or about the same?
Yeah, and that's a very good way to go into the next slide, and let me respond with the next slide. Can we just move to the next, please? Okay, this is really that piece of information, Jim. What we have here, the bars in blue, stands for the total volume of allocated CRRs that the load-serving entities have. And there are some caveats here, and let me try to clarify. The total volume of allocation CRR is not just straight what they get from the allocation process, because we do have other processes in the system in which we get other type of allocated CRRs to the load-serving entities, including, for instance, the load migration. So this is the absolute volume of the CRRs that the entity has, because effectively these are the CRRs that are at disposal for sale. The majority of this is going to be the volume that is effectively being allocated from the annual and the monthly process. And on top of that, you are going to have a portion of 2,000, 3,000 megawatts of load migration and trading hub counterflows that we have to release for feasibility. So overall, you can see that the volume is in the range of, I would say, 27,000 megawatts or so on average for the last 3-4 years. And when you take a relative comparison of that total volume against the portion of the CRR that are being sold, this is what you get now with the markets in red. And you can see that the relative proportion of the relative volume of CRRs being put for sale by load-serving entities has increased from basically 4% in 2017 to about 16, almost 17% in 2020. And this has two components. The first one, obviously, because there is more volume. I indicated in the previous slide that the volume has increased from 1,000 to 3,500, but also it corresponds with lower total volumes of allocated CRR. So the percentage naturally is going to be larger. Does that answer the question?
Yeah, it does. Thanks. Yeah, it would be interesting to unpack even just the it doesn't look like there's a dramatic shift here if you're kind of thinking about this month by month, but it definitely seems a little lower. And how that is coming about, whether this is more LSCs competing for the same flows, and so, or there's a change in the requests in some way. It'd be interesting to unpack that as well.
Sure, I think that will be useful.
Remember, one of the reforms was to reduce the amount that were allocated in the annual process and shift some of it into monthly so that we'd allocate fewer infeasible CRRs. So perhaps part of this is the change in the allocation percentages and not allocating CRRs that weren't feasible.
Yeah, I guess that's what I was getting at. Is like, how much is this from the changes to the sort of suite of changes that were put in place versus changes in the requests being made by the LSCs, because the composition of the LSCs is also changing.
Yeah.
Yeah. Correct.
I think it's striking. I think this is a very important figure, Guillermo, because it shows the importance of the auction to at least some subset of the LSCs as a mechanism for them to sell CRRs that they acquire either in the allocation process or, as you noted, they may be getting it in the load migration process. So it's not really the CRR that hedges their load. It's what the losing CRR, losing LSC was using for a hedge. So I think it's important that the LSCs that are gaining load be able to sell their CRRs at a market-based price.
Correct. That's a good point, Scott. Okay, next slide,
I think
please.
we have several questions on the phone line. Is this a good time?
Please go ahead.
Hi, Guillermo. This is Mike Kramick from Boston Energy. I just wanted to, I just had a brief comment. Scott kind of hinted at it, but I really want to thank you for the report and the presentation. I think it really disproves the narrative that loads don't find value or don't participate in the CRR auction. I think these slides are telling that, yes, loads do participate. It seems like they're participating more than they have before. So there is value out there for all market participants in the auction. And then my last comment, and then I'll go back on you because I'm not sure how long I can stay on the call. I just wanted to also thank you for your direct cause and effect in the later part of the slides talking about the San Bernardino-Devers constraint. I think it's very helpful when we see reports to see actual, causes of shortfalls or surpluses rather than just some general statement that are backed by facts and data. So I really appreciate this report and presentation, so thanks a lot.
Thank you, Michael.
We have a couple more people on the line. Please go ahead. Your line is unmuted.
Yes, good morning. It's Mark Holman with PowerX. Just a couple of comments and thoughts. One, I think this is great analysis, and it's really good to see that some of the measures as a result of extended stakeholder process have addressed some of the concerns around CRRs. And of course, any particular period, you're going to see numbers bouncing around in terms of the auction efficiency measure because grid conditions change, as was just noted. And so really appreciate the analysis and the good work that's been done here in terms of analyzing that. But one other thought I just wanted to flag for the CAISO and for the MSC as consideration is just maybe examining allocation efficiency. So we're seeing, really good data and examination on auction efficiency. But one of the and it's great to see that some entities that are getting allocations and don't need those CRRs for hedging purposes are putting them into the auction. But we still do experience harm in the forward markets where there are allocations that are not being used and not being sold. So one measure might be how many of the allocated CRRs were allocated yearly, held onto, and then not sold in the auction until the monthly period. Because what that does is between the annual and the monthly, that hedge instrument's not available for others to forward contract between suppliers and other LSCs. And then also perhaps what percentage of allocated CRRs that are held right through the delivery period are SCs actually using that to flow power, or is that just being used to collect value from the congestion on the grid? And again, just from a trying to get some metrics around how is the allocation working. Is there an inefficiency there associated with CRRs being held off to the side that aren't being used as hedge instruments, and recognizing that that's okay, but there is a cost to that there's no hedge instruments out there which can be a barrier to forward transactions. Thanks.
I think that is a very good point and food for thought of what other analysis we have to do. Yes, you're right that historically we have focused so much on the auction efficiency, and with the latest development that we have in the analysis, we have realized that there are many subtle details that make a dent on the overall performance of the CRR market when you start going into the allocation. And for some of those, I tried to put some metrics. Obviously, it's not comprehensive enough, but that is something that we can consider for the future.
I think, though, this is Scott Harvey. I think it's going to be hard to make an assessment of whether an LSE is using a particular CRR to hedge its congestion costs or just taking the money, because you need to have an understanding of all their hedging contracts and
yeah, it's a good question. How would you calculate whether, is there a way to calculate, I guess is the question, whether that LSE is also a scheduling coordinator that's flowing power across that constraint in a day-ahead market? So for example, if an LSE gets allocated a CRR for a quarter across a particular constraint, what's the most they ever flowed in the day-ahead market from their day-ahead market awards across that constraint? That might be one way, but I do hear you, Dr. Harvey, that it's a tough thing to assess. Really, what I was trying to flag is just that when CRRs get allocated and they're just being allocated as a way to capture the financial benefits of the system as opposed to being used as a hedge vehicle, it does cause inefficiencies, because we do see CRRs taken off the table, potentially not used, and then other LSEs and suppliers are stuck without a hedge vehicle, and it poses barriers and inefficiencies to executing forward transactions.
This is Ben, Mark. I want thanks for your comment. I wanted to ask you about the first part of what you said, where annual allocations are being held, and then parts of them are disposed of in the monthly auction shortly before the markets actually execute. If somebody has an annual allocation but really only needs it for a subset of months, is there an opportunity for them to unload the portion of the year that they don't need before the monthly auctions, or really they have to wait until then? Is that what's going on?
I think that's part of the challenge, is that, and it's not a criticism, it just is what it is today, which is the annual auction is quarterly, and so an entity may get an annual allocation. They only need 1 month or only need 2 months, but they have to wait until just prior to that month to sell the 1 month or 2 months off they don't need. So I think that's part of the problem. Of course, they may think they needed it, and then conditions change and they don't need it at all. It's just a good, easy metric to say how much was allocated and then sold in the annual auction versus allocated, never sold, versus allocated, sold in the monthly. That's a pretty easy thing, I think, to grasp. But again, it's just CRRs out of circulation, preventing entities from being able to forward contract who are looking for a hedge instrument.
But Mark, to the extent some of these CRRs are allocated CRRs or load migration CRRs, the load serving entity might not have had it to sell until later.
Understood. Understood that load migration also, they may not get it until it's time to sell it until the monthly. It's just nice to know how much is being immediately released in the annual versus held to the monthlies, sold in the monthlies, versus held all the way through. Again, just from a perspective of when there's CRRs out there and they're not being used, there are other entities, especially with all the load migration and also, of course, the CAISO grid becoming more dependent on imports. It's challenging when there's no CRRs available in the annual auction and entities are looking to enter into forward transactions, let's say for the summer period, and there's no CRRs there. It's helpful to understand that, to say, are there further improvements to get more CRRs into circulation in preferably the annual time frame?
Hey, Mark, this is Perry Servilio, ISO. I'm just trying to understand this, are you questioning whether LSEs should be able to retain the right to collect congestion revenues on their transmission assets?
Not at all. Not at all. I think that the LSEs should receive the value of the transmission system that they fund. I'm not questioning whether they should receive that value and how best to, it's really about how best to distribute that value. Of course, one way is allocate them to the CRRs. Another way is allocate them to auction revenues. I think the concern I have is that I think it's great that we've really focused in on the auction. We've looked at where the inefficiencies are. CAISO's led stakeholder process with multiple phases to address inefficiencies there. What I'm saying is that when you use an allocation process, it doesn't necessarily result in the best distribution of that CRR. In other words, an alternative approach would be to auction it all off. We're not proposing that here, but that would still ensure they got all the value of the transmission system, but they get it through the auction proceeds. So not questioning whether the entities who fund the transmission system should receive the financial benefits of that transmission system. What I'm flagging is that one of the core purposes of CRRs is as a hedge vehicle for forward physical transactions. And when those CRRs go out of circulation and become allocated and never used for that purpose, and that's happening through an allocation mechanism, that can create an inefficiency in the forward markets. It makes it difficult to forward contract because there's no hedge instrument for entities that want to transact between a supplier and a seller on a forward basis. So it's just, you know, I know there's other, and the MSC can speak to this better than I, there's other approaches out east that we've seen to make sure that that congestion value goes back to the load, but still make sure that the congestion hedging vehicle is made available to the market.
Candace, are there other callers on the line?
Yes, there's one other person on the line.
Okay. Let's have their question, and then we'll allow Guillermo to continue.
Please go ahead. Your line is unmuted.
Hi, Guillermo. I think this has been a really interesting discussion, and there's a lot of questions about why this number has gone up. And I think while it's hard to ascertain why they might be choosing to sell more, it might be worth surveying LSEs that sell or LSEs in general about their use of CRRs to hedge. Because one possible explanation that occurs to me is that the devaluation of CRRs as a hedge by virtue of them not being fully funded may be contributing to LSEs saying, well, you know, this product isn't helping me because, you know, I've got no idea what it's worth because it can be like worth half of what I think it's supposed to be worth, and I'm just better off selling it in the auction. So it may actually be an indication the increase in the selling by LSEs, not that they don't need it, but they're finding it to be ineffective to achieve, you know, what it's supposed to do because of the amount of underfunding. And I note that, you know, the jump in 2020 might be suggestive of, you know, just the high levels of revenue inadequacy and, you know, not fully funding CRRs that has occurred recently. It may not be the case. Maybe, you know, the paths that are being sold are fully funded or that sort of thing. But it certainly is plausible that there's a correlation between LSEs that are seeing their CRRs not be fully valued and their desire not to own those CRRs.
Yeah,
okay.
I think this goes to the point of effectively how much risk the entities are assessing for holding that CRR versus selling the CRR.
Yeah, but if we look at Guillermo's data, you can see that this increased sales started way before the reforms in 2019. And I mean, I think if we look at how much of it's load migration CRRs, we'll probably get a sense of whether this is driven to changes in who's the load-serving entity more than the reforms, but I think the changes in load-serving entity make it important to have an effective valuation that allows the LSEs gaining customers to sell these CRRs that they inherit at a market-based price.
But I think it's a good point that the mechanisms put in place do create kind of hard to predict risks on, or hard to predict changes to the hedge value of these CRRs, and I've been trying to figure out quantitative ways of trying to capture that, but I think it's a good idea to survey the LSEs to get their sense of how useful they are and whether they have changed.
Thanks. Just for the record, who was the caller? I didn't catch your name.
Hi, it's Abraham Klein with Appian-Way Energy Partners.
Oh, okay, thanks. Candace, is that it for questions on the line?
Yes.
Okay, Guillermo, back to you.
Thank you. Candace, next slide, please. Okay, to complete this topic, I think this is another angle of the component that we are exploring right now, and this gives you a relative contribution of the sales of allocated CRRs. And this is a comparison between the annual and the monthly processes. And what you can see is that the majority, about 70% of all the allocated CRRs that were put for sale, is only for the volume of CRRs put for sale, are taking place in the monthly auction. And naturally, we know that the monthly auction is the most active process that we currently have. The annual, given the cycle that it has and the far away that is from the actual trading days, may pose less flexibility for participants. And you can see that also the clearing ratios is quite high and revealing for this type of CRRs. They are still in the high range of the 80-90% of successfully selling the CRRs. Next slide, please. Okay. Now, the other component that we are able to analyze explicitly now by having this breakdown of the different types of CRR is really what we call the undervaluation or selling at a discount value the allocated CRRs. The unfortunate thing is that this can be done precisely prior to 2019 because, again, through the settlements, we are able to keep record of what the value was for the CRR that have been sold. Once we have the new logic, we lose that visibility. So we cannot explicitly or assess in the same way the valuation of the CRR's payments for those that are being sold. So we can only look prior to 2019 explicitly. Again, one could imagine that making some assumptions or some pro ratio, we can come with some level of assessment of what the implied value could be. But given the fact that under the current logic, even the same CRR definition, by the only fact that it belongs to different portfolios, may have a different valuation. So it's quite a lot of assumptions to make in order to assess a potential value of the implied CRR payments for those CRRs being sold. That is the main reason we are not even pursuing this approach. But looking back, if history repeats, we can expect that still some level of undervaluation is going to happen. We may put theories about how the pro rata funding may impact that, because if now the payments are lower, potentially the undervaluation may have improved. We don't know. That is the reality. We cannot precisely assess what the current undervaluation would be after the policy changes are implemented. But looking at this in 2017 and 2018, we can see that there are obviously variations across the time in which there were better months than others. And this follows somehow the similar logic that we have for the auction revenue efficiency. The bars in red stand for how much they were paid by selling their CRRs in the auctions. And the bars in blue stand for what the value would have been if they keep that CRR in their portfolio. So if they decided to have, if they have an allocated CRR and is worth in the day-ahead market $100, and if they decided to sell it for $60 in the auctions, effectively this is going to show a red bar of 60 versus a blue bar of 100, and the ratio would be 60 divided by 160%. So the undervaluation or underselling by a discount will be 60%. Overall, for this two-year period analysis that we have done, it amounts to about $31 million. Going back to the original discussion I introduced with the metric, prior to 2019, this $31 million would have been factored in the auction efficiency metric, and that would have been one of those components. We don't know, obviously, data-wise, what the reason behind it is. This may only be a reflection of the complexities and the challenges to properly predict the congestion that is going to realize in the market. And if you see the trend, for instance, you're going to see that typically the largest undervaluations really happen in the months where congestion was somehow quite volatile. That was July and August 2018. And it's not surprising that in these times, potentially the assessment of what the congestion would have been was underestimated. And this really speaks to the complexity of these CRRs to be hedge mechanisms for congestion that is quite volatile. Let's move to the next slide just to summarize some points so far. And obviously, one trend that we have seen very clearly is that the low surveillance are increasingly using the auctions to rebalance their portfolio, to manage their risk, and that has been a very steep increase in the participation. We know that CRRs from the allocation processes are being sold subsequently in the auctions. It could be either because they are undervaluing the complexities of the congestion that is going to actually realize, or they are willing to sell at a discount based on the risk and tolerance that they have for their portfolio. In either case, the point I wanted to put forward is that when we see the bigger picture of the auction efficiency, this undervaluation, I wouldn't treat it as an auction inefficiency. This is a problem of undervalue or underselling. Having an auction in the current shape or any other variation of an auction is not going to solve this issue. It's not the mechanism that we currently have for releasing CRRs what the problem is for this specific component of the undervaluation. Even if there is a bilateral trade, that doesn't ensure that this undervaluation is going to be magically disappearing. And this, again, talks about the complexity of really dealing with the risk, tolerance, and profile of the specific CRRs. And the other interesting conceptual concept that we term that we have here is that by the time an allocated CRR is put for sale and is actually being undervalued, effectively somebody else can willingly go and capture and monetize that undervalue. If I am an entity that is selling a CRR for $30 when it was worth $100, most likely somebody close to $30 is going to be able to buy my CRR. And if the day-ahead value was $100, now that entity, that CRR that is a buy CRR in the auction is going to actually monetize that undervalue. Again, the origin is not the auction efficiency. Somebody is willing to sell that CRR for $30. That is the undervaluation on selling at a discount concern that this poses. And this is what I have for the first part. Let's see if we have any questions so far before we move forward, please.
At this time, there are no questions on the phone.
Well, Guillermo, this is Scott Harvey. I think that this, the ability of load-serving entities to sell their CRRs at a fair price in the auction is a measure of auction efficiency. And although it is, to the extent they put a low reservation price on their sale, that contributes to it selling lower. But I think in a really efficient auction, you don't have to put exactly the right reservation price on it, people competing, to buy it, well, it should drive the price up. So it is interesting, though. We look at, it's worth breaking out and maybe looking at there's something, if we're going to focus on these allocated CRRs, is look at, well, what was the valuation of these CRRs in 2017 and 2018 compared to what would a similar ratio be for all CRRs? Was it actually worse for these in 2017 and 2018, or is it about the same as it was for all CRRs? And, the other aspect of this is, of course, it leaves unanswered the question of whether this got better. But now LSEs get, 85 cents on the dollar when they sell their annual allocated CRRs. And that's the problem you raised, that since we, with the new 1B proration rules, it's hard to know what the payment would have been on the CRR. We can calculate the notional payment, but to know what exactly would the after proration payout be is just too complicated to be worth the effort. So that's the tantalizing question. But we could look back at whether these were worse valued in or about the same valued as all CRRs back in 2018, and if it was about the same, then maybe their valuation has improved as well. That would be a reasonable assumption.
Okay, yeah, let me take that note. And I hear you, I understand, and actually it's very interesting because when I was referring to the fact that the origination is really from the undervaluation, effectively the metric that we currently have for auction efficiency still captures that, because effectively the auction efficiency metric that we measure is going to see the buying counterparty buying it for $30 versus getting paid $100. So it's going to be a 30% of auction efficiency. So in that sense, we still capture that inefficiency of the auction on its own.
That's a good point, Guillermo.
Okay. Do we have any other questions, comments?
Not at this time.
Okay, next slide, please. Okay, just to go through the completion of this topic, what you have here is really another component that we have explicitly analyzed now that we are able to break down the types of CRRs. And this one refers to what I have referred in the report as arbitrage. This is the classical arbitrage of buying low, selling high. We have two auction processes, the annual auction and the monthly auction. What this method captures is really the arbitrage between these two. Somebody can go and buy a CRR. Subsequently, that participant can go and try to sell that CRR. It's an auction CRR being sold in another auction, from the annual into the monthly. If somebody buys a CRR for $10 and then is going to sell it for $20, obviously is making an arbitrage between the two markets. When we measure this arbitrage between the auctions, well, we have come is that you can see quite a change, quite a drop in the volume of the arbitrage, megawatt-wide, after we have implemented the changes of 2019. The interesting part is that the magnitude in dollars is not that different. It has reduced, but it's not that dramatic or correspondingly to the level of the reduction that we see in the volumes. And overall, actually, the arbitrage of what we have in the auctions right now account for about a half of the overall auction inefficiency that we have estimated so far for 2019 and Q1 2020. And this is a very interesting area because the other consequence of this is that by having a participant buying in the annual and selling that in the monthly and getting the arbitrage, it can arbitrage and have no exposure to the day-ahead congestion. It's completely liquidated within the auctions. It's really pure arbitrage between the annual and the monthly. Next slide, please.
Well, Guillermo, this is Scott. One thing I want to point out that we have to keep in mind is that there is a a time value of money difference between the annual auction and the monthly auctions, and you need to look at, how much that is for the various months. Now, it's not clear that it's there's a big pattern to this, but some of these are purchased much further in advance than others, and having to pay for the CRR 18 months or something before it's settled, there's a significant time value of money cost.
Correct. Thank you. Okay, this other slide goes really to the genesis of the performance report that we have. And this is the one that captures the auction efficiency with the caveats that I had explained before. This is the revised auction efficiency using only as a reference all the CRRs from the auction that belongs to the buy activity, including the arbitrage. Buying in one, selling in the other is still part of the buy activity. The only portion that this metric doesn't include in 2019 and 20 is the corresponding portion of the CRRs being sold and that were originally allocated in both the auction revenues and in the CRR payment. And obviously, pre-2019, we have to do the same arrangement. What you have here is obviously the monthly variation that you could expect to see once we have all the changing conditions in the congestion on the market. This metric obviously is going to look quite dynamic, but overall, at least for the first 15 months of having the policy changes implemented, what we can see is that the ratio of the auction efficiency is overall 87%. That is quite higher than what we saw historically in the previous years. Please move to the next slide. This summarizes on an annual basis the performance. And the dotted red markers just refers to the original metric that was not really great to capture the new dynamic in 2019. And what you have here is two comparisons. One between obviously the old metric that is not relevant anymore, but the other one refers to one auction efficiency measured based on the notional value, the full CRR payment that is dotted markers in yellow. And once we account for the final pro rata funding that we apply, you got the markers in purple. And obviously, it's easy to isolate this because we know what the notional CRR payment is. We know how much pro rata funding has been applied. The reality is that even the pro rata funding has influenced the value of the yellow markers that is at the notional value, because obviously it's going to influence the valuation of the CRRs that are put for transactions in the auction. But that just shows you graphically the improvement that has been played with the policy changes altogether. It's not possible to dissect one component from the other, from the three policy changes that we have implemented. Overall, the improvement goes from 47% to 87%. And the percentages sometimes may be too narrow to give you the full picture. For that, you also have the comparison with bars. The red bar amounts to the auction revenues that we account for all the purchase transactions in the auction. It's basically the money that participants have to pay to get the CRRs. The bar in blue refers to the notional value, the full CRR payment. So prior to 2019, prior to having the pro rata funding, the auction, the CRR revenue adequacy would have been the delta between the red and the blue ones. Now, once we implemented the pro rata funding, we reduced the CRR notional payments from the blue bar up to the green bar. Obviously, prior to 2019, we didn't have such thing. It was full funding. But you can see the reduction, the improvement that the pro rata funding brings to the auction efficiency, bringing down the blue bar up to the level of the green bar. And that's quite a good improvement. Let me see if we have any questions so far.
We have one on the line. Please go ahead. Please make sure your phone isn't set to mute.
Hi, sorry. This is Tal Levy with Appian Way Energy. Can you hear me?
Yes.
just following up on slide, I suppose, 12 and 13, just trying to disentangle these numbers a bit more. I was curious if you had a view of what the impact might be. So in parallel with the formal policy changes, there was also a change to model a lot more contingencies and I think also monitors in the CRR option. I'm curious if the impact that might have had on these numbers to try and disaggregate it from these high-level figures.
Well,
is that something you've looked at?
I guess we don't have a number. I don't have a number in front of me to tell you value. I guess what you're going to see if we can do this analysis basically by set of constraints, right? Everything happens now at the constraint level. And whether to see if the group of the contingency-based constraints are making part of this improvement or not. We haven't explored that. It could potentially be feasible. I don't know if it is at this point worth to go back on a constraint-by-constraint basis when at the end of the day the CRRs are all based on the little contributions from different constraints.
Okay, thank you.
Okay, let's move to the next slide, please. This one is just to give you a different angle of the pro rata funding logic. Effectively, we are reducing the notional value of the CRRs, the full payment, down to the level that we can fund from the congestion rents accruing the day-ahead market. Prior to the implementation of this change, when we honor the full funding, effectively any deficiency would go and get allocated to measure demand as an additional uplift. By having this pro rata funding and bringing down the notional value to the level of the congestion rents, what we have seen is that for these 15 months of operation, we have overall a reduction of the rent shortfall of $146 million. That is money that is no longer uplift of measured demand because of the pro rata funding logic that we have in place. That, on the other side of the coin, shows you that overall, the value of the CRRs have reduced by that much. And if you put in context of the overall value of the CRR, that is about 29%. So system-wide, as a metric at the system-wide level, it means that the CRR value has reduced by 29% once we have the pro rata funding in. Okay, next slide, please. Okay, if we don't have any questions about this part of the presentation, I would like to move into a different and the second topic that I described earlier, and that is more specific to the drivers of CRR deficits. Can we check if we have any questions before we move forward?
We did just get one question on the line.
Hi, Guillermo. It's Callie Wells with WPTF. First of all, I want to echo the prior comment that we really appreciate the thorough report and presentation. It has a lot of good information in it. I wanted to follow up, and in the report you had a little bit more information, or I guess more analysis on kind of the whole, the shortfall allocation. And I know you're not speaking to it directly today, but I was curious if you guys have given any thought to whether or not it makes sense to make some modifications to how it's being allocated. And, you know, for example, I know it's there's kind of that monthly true-up at the end of each month, and, you know, if there's surplus on a given constraint, it can only help within that month, but yet you have some CRRs that are valid for 3 months, you know, your seasonal CRRs. But, you know, if you have a CRR that a seasonal CRR in 1 month, there's some surplus, that surplus can't help offset some deficit on another month. And so I'm just curious if you guys have given any thought into whether or not that you might consider some changes.
Hi, yeah, thank you for the comments. Let me try to answer generally on this, because I think you are bringing back the point of when you have deficits and surpluses, how can it be a matter of having both at the same time? The current discussion, well, the current implementation that we have goes back to the discussion of how to do the fundamentals of the pro rata funding. And the logic that we took was to do it on a constraint-by-constraint basis, to be specifically targeting those that are causing the deficiency. And yes, we do some netting monthly. At the end of the month, we allow the deficits and surpluses to be net each other for the same constraint. I guess what you are coming is whether there is any exploration to go beyond that netting that we currently have. We haven't explicitly put our thoughts around this to see if there is any merits one way or the other. I think we have a very well defined and logical explanation why we wanted to do this when we implemented the policy and when we developed the policy, to really be as surgical as possible to tackle really the causes and the root sources of the deficiency. At this point, that is my comment. I don't know if down the road, once we have to come with the assessment, whether there are any need for explicit improvements or changes that we have to pursue moving forward. I think naturally that could be a point of discussion where we can easily support with material that we have from the analysis.
Okay, I appreciate that. Yeah, and I guess I'll hold off on my other questions kind of towards the end of the presentation in terms of kind of what the next steps are. So, okay, I appreciate that. Thanks.
Okay, thank you. Candace, do you have any other questions?
Not at this time.
Okay, so let me then move to the second part of the presentation. And in the report that you have there, and also in the monthly reports that we have provided since the implementation of these initiatives, we have provided some visibility on what the constraints have been and the reasons for the deficiencies that we have seen. The beauty of having this pro rata funding based on a constraint-by-constraint basis really enable us to very explicitly identify what constraints and at what extent the deficiency and the issues have arose. And the trend that you have here reflects the relative contribution of the top constraints for the first 15 months of the year, of the implementation period, that have accrued to some extent CRR deficits. Basically, this is the money that is not collected on the constraint, therefore has to be reduced to be neutral. Ideally, we would like to see many different colors such that everything is distributed among too many different constraints, such that there is no one meaningful constraint accruing the problem, that we don't have a systemic chronic constraint accruing systematically the deficiency. In general, that happens across the year, with the exception of the portion that is highlighted here in red. There is one specific constraint that really drove quite a significant portion of the deficiency that we observed mostly in the last quarter of 2019 and spill into the early 2020 results. That is a constraint that we have discussed in different forums, including previous MSC and NPPF discussions. This is a constraint in Southern California that was related to a contingency constraint because of the different outages that happen in that area. Depending on the time, you may have different outages, different constraints that we enforce to handle that condition in the system. The deficiency values that you can see here are quite significant, and that is the reason we focus specifically on understanding what happened with this constraint. Next slide, please. This is a view of that single constraint for a period that goes from end of November through basically end of January. That is effectively when the constraint accrued most of the deficits. And I don't want to go too much into this slide because I want to go into the breakdown in the next slide. But overall, what I want to show you is a few comparisons here. We have the flows that were clear in the CRR auctions. The dotted red line is for the annual auction flow. The dotted yellow line is for the monthly auction flow. And then you have the line in purple. That is the clear value in the IFN. And effectively, that is the binding limit that was in the IFN. ideally, we want to see these three elements aligned. Well, let me caveat this. The annual auction is going to be obviously a pro rata value that is the 65% of the capacity that we release. But ideally, what we want to see is that the yellow line and the purple line are very close one to the other, because it effectively means that we are releasing the same capacity as CRRs to what the capacity release is in the day-ahead market. If we release less capacity in the day-ahead market, effectively we are making more restrictive release of the transmission capacity, and that is a recipe for being with an auction with a CRR deficit. The second comparison I want to highlight here has to do with the reference of the blue line and the green line. The blue line is what I have defined here as IFM settlement flow, because it's not the same as the IFM clear value. The IFM clear value is the binding limit, let's say about 300 in January. The IFM settlement flow is the transmission capacity on which we effectively collect congestion rents. And the reason for that difference to happen has to do with how we actually clear the congestion management in the system. And I will explain later. The point here is that ideally what we want to do is that the green line is pretty close or overlapping with the blue line. Effectively, we are saying we are collecting this much money as reflected with the blue line, and by the way, we have to pay the notional value with the green line. So that is the delta between these two is a CRR deficit. With the pro rata funding, effectively what we are doing is bringing down the green line to the level of the blue line. The question still remains that even though we have cured somehow the revenue deficiency by bringing the green line down to the blue line, the question is why that difference actually is there to start with. And I will try to walk you through the reasons for that to happen in the next slide. Candace, I would like you to move one click at a time, please. Next slide. Okay. Oh, this is not what I was expecting. Can you move one more time? Okay, I think this is not the last version I wanted to have. It's supposed to be an animated slide to build the logic, but let me try to make it on the fly. Let me start from the bottom. We have I have enumerated the different lines. These are basically flows or capacity of the transmission constraint. And again, this is only for this specific constraint. And this is just for a sample day where we can really spend the effort to nail down what really happened. Different days may have slightly different contributions, different dynamics, but this is a good representation of what a typical day of CRR deficit meant. The first line, that is the number one day-ahead settlement flow. For that specific snapshot that we took, we had a settlement flow of 185 megawatts. That means we collected congestion rents on that megawatt capacity of 185. For that specific time, the day-ahead clear binding limit was actually 205. There is a difference between what is binding versus what capacity is used to collect congestion rents. And that is because two main effects. One is the shift factor threshold that impacts the flow contributions that we estimate for the congestion rents, and the other one is the loop flow. The loop flow is capacity that is taken in the system but is not optimized to support schedules optimized in the market. This is capacity that is coming due to all the loop flow that we have with other balancing areas. And that takes away capacity in some cases. It may provide counterflow in other cases. In this case, for that specific condition, it was taking capacity away. These two factors alone led to this gap between 205 and 185. So when we see the overall CRR deficit, that accounts generally about 6%. This 6% means we didn't collect enough congestion rents to what in paper we could have, that is up to 205. So to start with, we collected less congestion rents than what we could potentially have. That is the first component. Now, before going into the next one, let me skip the rest and go up to line number 6. That line is the CRR settlement flow, that is 514 megawatts. That is the CRR flow that we estimate using day-ahead shift factors times CRR injections. This is effectively what the pro rata logic is applying when we do the settlements. Therefore, the difference between line 1 and line 6 is effectively the CRR deficit that we accrue on that constraint, because we collected only line 1 and we are supposed to pay up to line 6. Because we have pro rata funding, now we bring down line 6 up to the value of line 1. This is effectively what the pro rata funding is doing. Now, that taken, we need to still understand why that difference between 185 megawatts and 514 megawatts happened. We already explained 6% of that gap. Now let's move to the next one, the gap that happens between the line number 2, day-ahead clear limit, and line number 3, that is the CRR auction limit. We enforce a limit of 205 megawatts in the day-ahead market. We enforce a limit of 301 megawatts in the auction. That alone implies a difference of transmission capacity that was not released in the day-ahead market that could have resulted in more congestion rents accrued. Or the other way around, we released too many CRRs in the auction because of that limit being higher. That is basically the reasons that we explained before, that operators have to really handle that constraint in the real time, and we align the real time to the day ahead, and this 205 reflects that reliability margin created. That explains about 29.
Just to say, this is Scott. I mean, let's push that a little further, though. Why did they reduce the limit so much in the day-ahead market? Was that because they were seeing loop flows in real time? So that maybe you've got 20 megawatts, you've got 20 megawatts of loop flow down there and the shift factor threshold at the bottom, but maybe the difference between the 301 and the 205 is because, you know, the operators were doing it for a reason. They just weren't doing it for yucks. So were you reducing the limit because basically we were seeing large loop flows in real time, so we needed to use a lower limit in the day-ahead market to make sure we could keep control?
Yes. And Candace, can you just go back for a moment to the previous slide, please, to have a reference and go through Scott's comment? Okay. If we focus on the trend of the purple line, you can see that this line is not fixed at 205 for the whole period. It started basically around the same value of the auction limit, around 300, but gradually it was bringing down because of all the challenges that we have to deal with in the real time. And just as a context, let me make a pause here. What was the main driver for having this dynamic adjustment of the constraint in the day-ahead market? The process that we currently have is that we want to align alignment across the markets. We want to have the same limit in the day-ahead than in the real time, but also we want to have the same limit from the CRR auction and the day-ahead market. That is ideally what we want to have. Naturally, what happens is that the real-time conditions is usually what we have to handle, right? This is the operational condition we have to live with. This is here where the operators start to have struggles to manage the constraint. And there were different drivers for why the operators have to rely on this reliability margin in the real time. For instance, one of the cases that we have is that we start enforcing a constraint in the market, and given the series of conditions that we have in the system, the market was failing to converge on that constraint. When that happened, we are doing congestion management on the system. The market is moving resources down or up to manage that limit in place. Suddenly, when in the next interval, the market is not able to converge for this constraint, it falls off. Now the market effectively is going to dispatch any resource at any value because there is nothing to contain the flow on that constraint. The constraint is not visible to the market at that point when it cannot converge. Now, operationally, they may actually be going over the limit. And we have studied the causes for why that convergence happened, and the reality is that when that happened, the operators now are in a bad spot after the fact that the constraint comes back. The The way to handle that now is that they may have to start exceptional dispatching resources, doing manual actions to bring the limit, the real limit, down to the reliability limit. In order to hedge against that condition when it was happening, naturally they are going to create more reliability margin by bringing the limit down. That is one of the reasons that we have that reliability margin created in the real time. The other reason is that there are many resources that are quite effective for this constraint that are variable energy resources, VARs. When we have this issue that resources may not be following the dispatch or we have the persistency off, we may get the case where they overshoot in the production. We are decking some resources. Once we don't deck those resources, they don't go back naturally to the DOT. They may go back to the natural production they can or they are able to produce, and now the constraint may be shooting over the limit. This is another factor that play a role to try to be more conservative in managing the constraint in the real time. This explains what the need was to have that management in the real time. Now, we cannot just leave it to the real time, because if we leave it there, it's a recipe for disaster, because now we have a misalignment between day ahead and real time. In the day ahead may not be even binding, and the real time is binding very heavily. Naturally, our process is to align the day ahead to the real time. And if we see that there is a consistent reliability margin created on a constraint in the real time, we are going to transpile that reliability margin into the day ahead to align the market. That is the reason that now the conformance, the reliability margin, moves into the day ahead market. And that is the reason you're going to see that over time, they found basically the place where they see that they can handle the real-time conditions. And that transpires into the day ahead. The next step that we actually want to do.
One question on that. So I understand. So if I understand, what was happening in real time is you had resources that weren't following the dispatch, and variable energy resources, as output was bouncing around. So you needed to get the flows down in real time because you couldn't manage it in the dispatch because of the time lags and everything. Was this something that happens all the time, or was this something that because of some outages that happened, normally this isn't a problem on this constraint, but because of an outage, it created a condition where they couldn't control it? Or is this something, if this is something that happens all the time, you'd think we'd model it?
Yeah, I think for this specific constraint, it was more extreme. We have seen cases where this may happen in a less severe mode. And the complication that we had, and this is going on the site, but we have an initiative that we clarified the tariff requirements a year ago on a rule that we have for resources to follow the DOT, including the VR resources, because VR resources naturally may want to produce at full capacity, as capable as possible. But in some cases, when these resources are behind constraint like this one, it creates a congestion management problem if they don't stick to the specific DOT instruction that was cleared by the market. Because once there is no supplemental instruction sent to them, naturally it's not to follow the DOT, but basically produce at will, and that can actually overshoot beyond what the market was thinking would be for the congestion management.
Thank you.
Yeah. Okay, and the last point I want to emphasize here is that now that we have aligned the day ahead and the real time, the natural step in our process is to align the CRR market to the day ahead. The unfortunate thing is that when we are dealing between day ahead and real time alignment, we are talking about a few days, because we have to see a consistent pattern and sustain so that we can move it into the day ahead. The gap that exists naturally between the day ahead and the CRR market is way longer, because obviously the current month is done. If you are maybe too late in the current month, you may even miss the subsequent month. So there is a natural lag of how soon that limit can be brought into the CRR option. So that is one of the reasons that we suffered in November and December, because it was just not on time to be able to make it effective for the CRR processes. Okay, Candace, can we move to the next slide, please? Okay, this is what really explains the difference of the limits between the auction and the clear. And obviously that is driven by the different utilization of limits in the two processes. And that amounts to about 29% of the deficit. The interesting part now, if we go into the next line, the comparison of the delta between line 3, the auction limit, and line 4, that is the auction flow, you can see that there is a difference of 65 megawatts. This is what really happens. We have an auction for which we impose a limit of 301 megawatts. The flows that resulted in the auction are actually 366 megawatts. In the day-ahead market, this is what we call a transmission relaxation or a transmission infeasibility, and therefore we cannot we enforce the limit, but we cannot honor that limit. Naturally, we have to expand the constraint. We have relaxation of the constraint. That also happened in this case for that specific constraint in the CRR auction. We enforced a limit of 301. The actual flow was 366. Why do we have to do that in the CRR? The reason was that once we go into the monthly, anything that has been awarded or cleared up to that point is already to be considered fixed. We cannot re-optimize what the annual awards were. It is what it is, and now we have to start with those as given as fixed. Effectively, it means that we have to start with a solution that is going to, with a feasible starting point. That feasible starting point was 366. What is this telling is that based on the results that we already have from the annual allocation and auction, we already were infeasible to go into the monthly auction. And that effectively is because we have model changes between the annual auction and the monthly auction. There could be different outages that were not captured yet in the annual auction, and now they are showing up in the monthly auction. These conditions are going to create the difference between the two auctions, and therefore now, in order to honor what was already awarded in the annual auction, we have to start at 366 to start being feasible and then clear. Effectively, nothing else is going to be clear for positive prevailing capacity in the monthly auction. That relaxation between the annual and the monthly that reflects the difference of models between the two auctions accounts for 65 megawatts of the CRR deficit. That is about 20% of the overall deficit. Then we can explain already how we get up to 366. We still have the delta between 366 megawatts and 514 megawatts. This is where we were missing the last piece to the puzzle, and that has to do not with the CRR auction. Let me be clear. The CRR pro rata funding logic doesn't have an error. It's not bad in the logic that we implemented. It's working as intended. It is an interplay between the CRR market and the day-ahead market that is causing this delta of 366 against 414. And that has to do with the threshold that we currently implement for the day-ahead market. Any resource that has an effectiveness of less than 2% is not going to be utilized in the congestion management, is not going to collect congestion rents in the day-ahead market, and that has been widely discussed. The implication that this also has, it was revealed until we did this exercise, is that there is also an implication for the CRRs, because in the CRR market, we don't have that shift factor threshold. And again, the CRR factor, the shift factor in the CRR option is only for the differential. It's not for one specific location on its own. It's for the pair-wise sourcing differential. But let me put this example. You may have, for instance, a CRR that goes from Palo Verde to DLAP SCE. Palo Verde shift factor for this constraint is, let's say, 15%. The shift factor for the DLAP SCE in the day-ahead market, given the threshold round off of, let's say, was 1.5%. Because of that, effectively, the day-ahead shift factor used for DLAP SCE is going to be 0. So in the CRR, we may have used 15 minus 1.8 to get the shift factor for that CRR. When we go now and apply that to the shift factors for the day ahead, it's not going to be the difference of 15 and 1.5. It's going to be just 15 because we basically fall off with the 2% shift factor threshold for the DLAP SCE. This is going to create differences now between the flows that we release in the CRR auction versus the ones that we are setting for CRRs based on the day-ahead shift factors. That alone is accounting for about 40%, and that is the delta that goes between 381 and 514 megawatts. This is the last link that really makes the piece complete and explains the different components that drove the CRR deficit for this condition. And obviously, this highlights that the shift factors have a big effect in two sides, in two directions. Can we move to the next slide, please? Just to summarize this, what we have done is a comparison between using effectively the current setup that we have using a shift factor threshold of 2% versus what would have been the CRR settlement flow calculation and the congestion rent calculation if we don't have any shift factor imposed. On one end, we are going to collect more congestion rents. On the other end, we are going to have less CRR payments. That effectively is going to shrink the CRR deficit to a more reasonable amount. It's not going to eliminate the CRR deficit because, as I explained earlier, there are other drivers leading to that CRR deficit. The piece that we have analyzed here is somehow very reflective of what's going on in the market. And again, this is not specifically something in the CRR market or the day-ahead on its own. It's the interplay happening between these two markets. And let me pause to see if we have any questions.
We have one person on the phone. Please go ahead. Please make sure your phone isn't set to mute.
Hi, Guillermo. Thank you. This is Abram from Happy and Way. This is very helpful. Really appreciate your going through this. I had a few questions on the previous slide, just to try and understand.
Can we go to that then? Thank you.
Yeah. So what is the difference between the shift factor cutoff issue in item 6 and the shift factor threshold that's discussed under item 2, like where the loop flows are?
Yeah, it's the same. It's the same cost, but different consequence. For number 2, what is happening is that we are collecting less congestion rents. Basically, we are truncating or falling off for specific IFM flow contributions due to not accounting for this 2%. Line 6, on the other end, is for the same dynamic, but applying it to the CRRs, not to the IFM flows. Number 2 is CRR IFM flows. Number 6 is CRR flows.
Got it. Okay. And my next question is, previously, I think it was on one of the biweekly calls, you had stated that one of the biweekly market updates that the reason for the derates on the Devers constraint was due to loop flows, which is what Scott Harvey was asking about. But it seemed like it was a slightly different reasoning here, and I just want to understand that is that a clarification or just what's going on there?
Yeah. Sure. Let me characterize better this. Let me try to do a better job. What I indicated earlier is that there were different drivers and dynamics happening to manage that constraint. What I just mentioned about the convergence of the constraint failing sometimes in the market and the VR dispatches is two of other reasons. And let me try to put in this context. When we're in the control room, right, all what you see is that your limit shoots up and you are over the limit and you are overloaded. You are not able to grasp why is behind that overload. As you start understanding the conditions, you may realize, oh, yeah, there are some unscheduled flows that we don't know. We just see the effect. Oh, yeah, we have VR moving around, and now we have to caveat for that. The loop flow may have been also a factor there, It's hard to quantify because this is just in real time as it happens, and this is what the operator is looking at the real time. What we can go back and see is if effectively the actual flows were somehow off with respect to the real-time market flows. But that could have been another possibility that we have explained in the past. It's not an exhaustive list of what else could have happened.
Mm-hmm. Okay. That's helpful. For the issue of sort of the continuing, I think Scott was getting at this question, the fact that more transfer capability was released in the monthly auction. I mean, this had shown up as early as November in terms of significant V rates on the constraint. And I'm not sure if you're saying it's sort of the policy that, maybe go to the previous slide on 16, that the monthly auction has to release this extra capacity up to the yellow line because, the purple line is not that far off from the red annual auction line. And I know that there was some additional factor from outages not modeled in the annual auction and that sort of thing. But it seems like there would be value in being more conservative about how much flow was released, extra transfer capability was released in the monthly auction. Do you have discretion around that, or is there some tariff aspect of it? Because, you can see, into November, this was already significantly derated. And it continued down.
Yeah, Abram, you should let Guillermo explain, because I had the same misunderstanding you did. Guillermo, why don't you explain to Abram what's going on before, because you're misinterpreting what's there. Guillermo, explain what you explained to me about what the yellow line reflects.
Yeah, so the line in yellow, Abram, is not the auction limit. Is the auction flow. And if you put this piece together with the next slide, I explained that in some cases, because the difference of models between the annual and the monthly, the auction flow was higher than the auction limit. In the case that I illustrate in the next slide, it's by 65 megawatts. So this really doesn't capture what the limit was for the CRRs. It only tells you how much you release. If we have a transmission infeasibility in the monthly auction because we already released too many CRRs in the annual, that line is going to be even higher than what the limit should be. Maybe to do more justice, I may have put additionally the actual limits used in the market, but it is not that reflected in the line in yellow.
Yeah. The issue is the shift factors changed between the annual auction and the monthly auction, so that when you got to the monthly auction, the same CRRs you'd sold in the annual created these flows that are way over the limit. So you had to, set the limit at what you'd already sold.
Yeah, but I think on this particular, there were a couple of options here, though. The CRR limit could have been dropped to some extent in January 2020, and I think, you generally did have these major outages had been modeled, at least as far as I can recollect, in the annual auction in 2019. And so it's just a really huge disconnect between the two. And in December of 19, you'd already sold like 390 in the annual auction. So, it seemed like there might have been some options in terms of reducing the CRR limits in the monthly auctions.
Yeah, and I'm sure, Abram, if we go proactively and try to be very conservative by bringing down limits in the auction, we're going to hear right away from participants why we are holding capacity in the auction. I think we have a process. That process naturally has a time lag because let's say if we have late November start to see that we have to bring down the limit. By late November, we're already done with the December auction. December is done. No matter what we do, those CRRs are even already released for the monthly auction. Our best chance will be to try to do something for January. And this is a conservative approach we are trying to take to make sure that we have a supported basis for moving with reducing the transition capacity that we release in the auction. And this is a very well-supported approach that we have, that until we see these conditions to happen in the day-ahead market, we transpire those into the CRR market. Yeah, it would be good to be able to be more aggressive, more proactive, and maybe that is something that we should discuss. I'm sure we will hear back very soon on the other side of the spectrum why we are holding so much capacity in the auction.
I think we have one other question in the queue. Is that right, Kit? Go ahead. Sorry, Abram, go ahead.
Oh, yeah. So I guess the last question, just on, and I'll turn it over to whoever's next in the queue. Just on the next slide, in slide 17, I did want to try to understand in general the issue with the loop flows and the 6%. And I'm wondering if there's any data here, because, you know, this to me seems like an issue where you may have external non-Cal ISO entities who have rights to bring in power at the border, which are naturally using up a certain quantity, which is modeled and assumed in the CRR auction, but then because this is an internal California constraint, basically, that's on the path for which those non-Cal ISO entities have rights, and those rights are not derated in any way, they may actually be accounting for, I think this was just Scott's question, some of the difference between the CRR auction limit, the item 3 and item 2 here, where, you know, it strikes me that this may be a systematic issue that's going on, even going back historically beforehand, which may have been accounting for a lot of underfunding, that when you have outages, the non-CAISO entities are it's almost you can assume them being given almost like preferential access to Cal ISO's grid without having to pay congestion, because they're basically modeling their flows on the system without derating that, even though, and they're taking up a higher and higher percentage of internal California constraints. And I'm wondering if there's a way for California, when you model the constraint flows, which you're keeping track of in order to calculate the D rates, whether you can keep track of on an ongoing basis the flow that is associated with non-California market participants, whether you want to call that loop flow or something else, because I think it would be very helpful to see if there was some systematic bias that is coming from that, because there may be some ways to have policies that would, you know, explicitly address that. Some of the ISOs in the East do that. So I guess my request is for the ISO to start collecting data for, you know, all of the constraints when you're calculating, you know, the funding level on the constraint of how much flow is coming from external non-Cal ISO entities on the constraint, and how much extra capacity they're using relative to what was assumed in the CRR auction, because that obviously would account for a lot of the underfunding, and it may actually have historically accounted for a lot of the underfunding as well. I definitely appreciate that you guys have brought forward the issue of the shift factor thresholds on causing a big chunk of this, and that's probably been an impact historically as well. But it just seems to me, given the flows that come in, you know, from Palo Verde and from other areas, and the way California has a lot of non-Cal ISO market participants who are embedded within the Cal ISO system, that it's not something where we would want to give them preferential access, because ultimately that comes back and harms the IOUs in terms of devaluing the CRRs, whether they're allocated or auctioned, anything like that. So that's my request for the data.
Thank you, Abraham. And I hear you, and I think I have heard you about your question in the past. I think typically we have to target the big items, and I believe overall among all the things that we have identified, I don't see any data that may be supporting the fact to indicate that the loop flux is the biggest issue or one of the biggest issues here. Historically, I think it has early February, March 2019, when I was discussing the CRR performance, I brought the discussion of two specific constraints in the south that were also impacted by loop flows. But beyond that, even for this specific constraint, I have also some material in the report that shows that, yes, loop flows is a contributor, but it's in the range of not as much as what the shift factor threshold is. And given the competing things that we have to track to be able to address and improve this performance, right now our effort is going to be focused on the shift factor threshold. I understand the request for data. We will have to see if that is feasible, because one of the complications that we have is that this data is dynamically created in the market as part of the power flow. It's not something that we predefine and put it into the market and it's set and fix and forget. So this is a dynamic piece. And even if we were able to quantify and get the values on an hourly basis for the last month, you will be surprised pretty soon that it's quite dynamic. It's going to change a lot. Sometimes it's actually going to reverse directions. And when you take that as a reference to see how you need to adjust the auction limits in the auctions, the challenge is going to be, what do I come with? It's going to be no more sophisticated than a best guess of what value you want to reduce. In some cases, if the loop flow is actually providing counterflow, it's actually increasing the capacity of the constraint. So there are some practical implications of, even if we were able to gain some visibility on the contribution, we are going to run into the complications of what we can do with that. Okay, so let's go to the last slide, Candace.
There may be one more other question on the phone line.
There are no questions on the line at the moment.
Okay, thank you.
Okay. Next, please. Okay, this is just my takeaway slide, and just to summarize what we have discussed today. In short note, we can see that there is an improvement after the implementation of the policy changes. We can assess that up to 87% for 2019. I believe Q1 2020 in the report indicates that it's about 80%. There are CRR deficits that continue to happen. I experienced specifically one of those in one specific constraint. Among all things, we have to realize that even though these deficits are happening, they are neutralized with the pro rata funding that we have in place. It may not be the same one-to-one relationship of where the CRR payment, the additional CRR payment is happening that now is going to be reduced, but effectively system-wide that is neutralized. About a half of the auction shortfall that we have for this period has been really accrued on the arbitrage opportunities between the annual and the monthly auctions. I also emphasize the new metrics that we have related to the undervalue of selling allocated CRRs. And just to close the discussion on this, the last piece obviously is that we have something to fix here to improve, and that is the application of the shift factor threshold. And I think we are exploring right now. We expect to move forward with some tariff clarification that we want to pursue to handle this shift factor threshold. So in the upcoming weeks, there should be something visible for participants, because we want to enhance this area that effectively should help us to reduce the CRR deficits that we have observed so far. With that, Ben, that's all I really have for today. Thank you for the opportunity to provide an update.
Thank you, Guillermo. Let me first check and see whether Jim or Scott have anything they would like to add, and then we'll go, make one last check of the phone lines.
Nothing from me.
Yeah, nothing from me either.
Okay. Candace, is there anybody on the phone lines?
Yes, we have 2 people on the line. Please go ahead.
Hi, Guillermo. It's Callie Wells again with WPTF. So just, I guess, more of a process-oriented question on the potential tariff change for the shift factor issue. Do you guys anticipate just posting draft tariff language, or is it going to be more of a formal stakeholder process first?
We're still assessing that. I think we should see something coming publicly one way or the other in the next few weeks.
Okay, and then do you anticipate there to be, I guess, any room, if it is a stakeholder process, any room for consideration of other improvements, or is it just going to be very narrowly focused in on the shift factor issue?
Yeah, regardless whether we end up with a tariff language change or a policy, a more formal policy, this is going to be very narrow about the shift factor threshold because we're going to improve this area. And that is not going to be part of a bigger component. Anything else that may fall in the CRR space may come in a different way.
Okay, thank you.
You're welcome.
Thanks, Callie. We have another question?
Yes, please go ahead. Please make sure your phone isn't set to mute.
And it was. Thank you. So, Guillermo, I just wanted to add, of course, these breakouts of the shortfall are very useful and very I've never seen anything like this from the other ISOs, and I just applaud you for the work on these. When I look at the page 17 where you have that, you have the outages not modeled in the annual auction. That's a fairly significant amount of the overall shortfall contributions here. Is there any effort to try to get a better glimpse into what the TOs are doing on a forward-looking basis? I know that can be challenging due to outage plans often not having that far ahead of a foresight. But is there anything that you guys are doing to address that, or anything you're thinking of there?
All what I can tell you right now, Seth, is that we are having internal discussions to see what areas we can improve within our scope of the production function that we have. And I think at this point, I'm not ready. We haven't gone to the point where we know exactly what items we're going to take on for improvements, like the shift factor threshold for sure, but we haven't explored how far we can go in other type of improvements that we have. I think we are at the stage where we are discovering and realizing the different dynamics that are impacting more heavily the deficits, and this is just the first step. So bear with us for us to figure out how we can address some of those.
Okay. Thank you.
Sir, would you mind letting us know your name and your affiliation?
Was that Abram from Appian Way?
No, I'm sorry. This is Seth with DC Energy. Thank you.
Thank you very much. There are no further questions on the line.
Thank you, Candace. I think we can conclude the morning session then, take our 53-minute break for lunch, and see everybody at 1 p.m. Pacific time. Thank you again, Guillermo, and look forward to talking about system market power this afternoon. Operator, we can conclude the morning session and reconvene in 53 minutes.
Thank you.
Thanks, everyone. Please come back at 1 p.m. Pacific time.